Hi, this is Charles Weeks from Barrister with another Barrister Brief. Today we're going to talk about the Fed's interest rate cut yesterday of 25 basis points and what that might mean for our financial plans and where we're going to see the impact of that cut the quickest. First and foremost, unfortunately, we're going to see it where we don't want to, right? It's going to negatively impact our savings. I checked today, and Schwab has already reduced its money market yield from its government money market yield from 4.07% to 4.05%. So we've seen an immediate impact there, and I'm sure more to come in the lower end of that rate as the short part of the yield curve drops with the 25 basis point cut in the Fed funds rate. Where else might we see some impact from that Fed funds rate cut? We're likely to see in home equity line of credit rates, where within the next month or two we should see a 25 basis point reduction in that loan rate. May or may not see something in our credit cards. Probably not. Where we're not going to see anything is in our mortgage rate. If you have a variable rate, you might see something with a slight reduction there. But as far as, if you're waiting to see a mortgage rate reduction, you're waiting to buy a house, or you're waiting to refinance, and you think the 30 year is going to come down or the 15 year is going to come down, those rates have not come down, and they've actually increased since the Fed cut rates. So why is that? Why is it that the Fed is cutting short-term rates, but mortgage rates are not coming down? The mortgage market and mortgage rates are based more on the 10-year government bond than what the Fed does with the federal funds rate. So when you hear that the Fed is cutting rates, the Fed is cutting the federal funds rate, which is an overnight rate that banks lend to each other. That has some impact on the economy and interest rates overall, but it doesn't set the rate for everything. And mortgage rates, again, they take cue more from what the 10-year government bond is doing. And the 10-year government bond has actually increased. Now, why would that be? Well, why would it be that the Fed's cutting rates and the 10 year is going up? People in the bond market could look at this and say, we're not really happy that the Fed's cutting rates, might cause inflation, still worried about the amount of government debt that we have. And if you think about what the market rate does, if you think about the yield curve from short-term rates to long-term rates, it's really a market rate. It's what people buying bonds from the U.S. government expect to get in return for lending the government money. And to lend the government money over a 10-year time period, they believe that the risks have increased over the past 24 hours. So they want a higher rate of return than what they had required before. So again, that could be inflation. Maybe there's a feeling that cutting rates right now could cause more inflationary pressures, and therefore if you're a fixed income holder, you need a little bit more yield to make up for that higher inflation. I think from a standpoint of why would the Fed cut rates right now? What's that 25 basis point, cut? Is it to spur the economy? Chairman Powell pointed out that this is more of a defensive cut, right? We're trying to play defense a little bit. What they're seeing is job growth has slowed down a little bit. There's been some revisions to the job numbers that haven't come in great. I think if you step back and look at the market is at all-time highs. Employment is pretty good. Inflation has been up over the past 5 years. We've talked about that, at length about how much things have increased over the past 5 years. Is it a great idea for the Fed to be cutting rates right now? I think a personal, opinion is that the Fed is cutting rates because they foresee that there's going to be trouble, in the future. Things are great now. We're always at all-time highs before we're not, and the Fed had cut rates prior to other, financial issues that we've had in the past, but things that I've been defensive about, and I remain defensive, things that concern me are the amount of government debt that we have, the amount of consumer debt that we have in student loans and credit cards. There's a whole bunch of buy now, pay later, that isn't accounted for in that consumer debt number that we look at, and the amount that things cost and the amount that's going on credit still for those increased costs. So also markets at all-time historic valuations, and a lot of the performance driving the market right now is based on just a few stocks. And the AI story is that we're going to spend billions and billions of dollars, and there's not so much of a clear path on on how we get revenue production, profit margin increasing from all that AI build out, other than, hey, we're going to fire a lot of people. And that is not good for the economy, right? Good for a couple companies that can afford, to maybe slim down, have higher profit margins with less employees. But if you're going to fire, 50% of your staff to get higher profit margins, those employees that are now unemployed, that's going to trickle down negatively through the economy. So again, Fed cut rates 25 basis points. Typically would be bullish. We're at all-time highs. The market reacted, positively to this rate cut, but it was pretty much expected. The bond market didn't overreact to it, but didn't necessarily react positively to it, and that the 10-year has gone up a little bit. It didn't come down, so there's not going to be a positive impact on the mortgage market at this point. So, from a portfolio management standpoint, we're going to hold steady, in our defensive posture. From a financial planning standpoint, possibly if you need to, you'll be able to take a little bit from your HELOC now at a little bit of a lower rate. Unfortunately, you're going to get a little bit less on your savings accounts and your money market accounts, and there really shouldn't be too much other impact to other rates that you have at this point from this rate cut. So stay tuned for more, and as always, if you have any questions, feel free to reach out. If you want to find a little bit more information about the firm or some other of these past Barrister Briefs or our quarterlies or anything else, check out the website at barrister.net. Take care.